So the next lecture, this is basically the same lecture that I gave last week, but I expanded on it because I wrote down a lot of the graphs like really small, and I figured that's a good way as an introduction, but I think we need to go through it one more time, and I'm probably looking for some participation too. Could you hand me maybe some of those markers too, because I'm going to need to write some stuff down. So what I did was I broke up the 5 asset classes. I'll take it again. I broke up the 5 asset classes, and again, this feeds right back into the memo. Right? The trades feed into the memo, the technical analysis and fundamental feeds into the memo, and then the fundamental economic analysis of the five major asset classes feeds right into the memo. Okay? And I don't know, I think I have this lecture up on the website. So I broke down the 5 asset classes, major asset classes. Stocks, oil, gold, bonds, and foreign exchange. I used a microeconomic analysis to be able to analyze the markets. We are going to look at the price effects within these markets based on supply and demand analysis. Supply shocks and demand shocks, okay, in the different scenarios. There's 2 scenarios for demand, there's 2 scenarios for supply for each of the asset classes. So let's start with stock prices. Obviously, you're going to start in equilibrium where supply and demand are in equilibrium, which is the E at the given quantity supplied, and the price will then be determined based on the intersection of the supply-demand curves. We're going to do demand shocks first. First, we are going to shock the system, and the demand curve is going to shift up. Okay? It's going to push out the quantity demanded, and it's going to push up the price. Okay? So demand shocks will have an effect, an instantaneous effect. Positive demand shocks will have an instantaneous effect on the price of stocks. Then what happens is, and I didn't do this, but usually what happens is the supply curve will shift out and the market will go back into equilibrium. You can also have negative demand shocks where there's a sell-off in the bonds. Falling demand for equities, higher demand for bonds. So you get negative demand shocks. That's going to shift the demand curve down. It's going to shift the demand for those stocks down, and it's going to reduce the price in the process. So that's the demand side. And the demand for stocks, remember, and bonds are inversely related in most cases. If there's fear in the stock market, demand will drop and demand for bonds will go up. If people want to move from safety and liquidity from bonds to stocks, they are going to sell off their bonds, and the demand for bonds are going to be less, and the demand for stocks are going to go up. So you can look at it in a demand context. We can look at it in supply. Obviously, you start off in equilibrium, supply and demand at the given level of quantity that then sets the price. The supply curve could shift out. All of a sudden, you get a lot of secondary offerings, a lot of IPOs. There's a flood of new stock issues or secondary issues in the marketplace. The market is flooded. The supply curve shifts out. The quantity supplied shifts out, and the price drops. You could also have a hoarding of stock in the marketplace. People are buying stock, they're holding them, they're not trading them, they're not being available. So the supply curve shifts back, you have a negative supply shock, there's not enough supply of securities in the marketplace for demand. The demand curve, or the supply of these securities will shift back, and the price will go up. Okay, what are some of the economic factors? I just told them that we can put up here really quickly. The shift into bonds, right, or the shift between stocks and bonds could cause the demand curves to shift. How about the return? Could be the return between bonds and stocks could cause the demand curves to shift. We could get lots of, IPOs and secondary offerings. It could have an effect on the supply side. There could be hoarding of the securities. People are holding them, they're not liquidating them, they're not trading them, which would create a negative supply shock. Oil prices, same thing. Let's do demand first. You're going to start off in equilibrium between supply and demand, which is going to set the quantity demanded at the given level of price. You shock the system, it shifts the demand curve up, the quantity demanded shifts up, and so does the price. You can do the same thing. There could be negative demand shocks for oil, where you have the demand curve shifts down, the quantity demanded shifts down, and the price drops accordingly. On the supply side, same thing. Start off in equilibrium. You could get a negative supply shock where you get a lot of supply coming on, which is happening right now. The quantity supplied increases and the price drops. That's what's currently happening. You could have OPEC, in this case, that's cutting back along with others within the cartel. That will restrict the amount of supply coming into the market. It will shift the supply curve up, which will reduce the amount supplied and increase the price in the process. So the factors that could be driving these is going to be supply from fracking, competition by OPEC. Basically said they're going to produce and try to drive the frackers out, so they're going to just continue to produce. You have Iran that's coming online. If there's Middle East, unrest through the Straits of Hormuz, if the Syrian situation increases and we start to have warships, particularly Russian warships in the Straits of Hormuz, the market's going to freak out and think that the supply chains are going to be disruptive, and that's going to cause the market to think that the supply curve is going to shift back and the prices are going to go up. Any other factors in here? Oh, how about energy efficiency? Energy efficiency is going to cause the demand curve to shift down and cause the supply curve to shift out, because there's too much. Okay, let's do gold prices.
You mean Bosphorus Strait?
What?
The Black Sea, Bosphorus Strait?
Yeah, the Straits of Hormuz is where the main shipping channel is in the Middle East, right next to Syria and Somalia, where a lot of the tankers go through. Gold prices. Demand side, start off at the equilibrium, shock the system, demand curve shifts up, quantity demanded shifts up, price shifts up accordingly. You get a negative demand shock, shifts down, quantity demanded shifts down, price shifts down accordingly. On the supply side, positive supply shocks, supply curve shifts out, amount supplied shifts out, prices drop. You get restrictive supplies, where the supply shifts back, the amount supplied shifts back, and the price goes up. So what are some of the factors on the gold side that could drive these demand and supply curves to shift up and down? What?
Inflation.
Yeah, inflation. You can just yell it out. Central bank purchases and liquidations. Fear. Risk.
Discovery of gold.
What?
Discovery of gold somewhere.
Yeah, discoveries. Refining, maybe other technologies to mine and find new gold reserves. Yeah. Bond prices. Start off in equilibrium, get a demand shock. Demand for bonds increases when people are scared. They want out of the stock market, they want liquidity and safety. It's going to shift the demand curve out. Quantity demanded shifts out, prices go up. What direction do interest rates go? Down. Negative demand shock, selling off liquidity and marketability, selling off the bonds, going into the stock market. Quantity demanded shifts back, prices drop in the process. If prices drop, what direction do interest rates go? Up. Supply of bonds. Supply of bonds shifts out. The Treasury Department decides to issue $1 trillion worth of bonds to fund the structural budget deficits. There's only 500 billion in demand for that trillion. So there's a gap, there's an oversupply of bonds in the marketplace that nobody's gonna buy, shifts out the supply curve, the supply of bonds increases, prices drop, and interest rates go. Please respond. If prices go down, interest rates go up. Okay? If there's a huge demand for bonds because people want liquidity and marketability, and there's not enough supply out there to be able to make their trades, the supply curve is going to shift back, the quantity supply is going to shrink, and the price is going to go up, and interest rates are going to go down. Excellent. What are some of the factors that would cause bond demand and supply to shift up and down? Interest rates, fear, inflation, Fed policy, liquidity, marketability, how about volatility in the stock market, how about recession, how about financial crises, all those factors. Yeah, Donald Trump controls the multi-trillion-dollar bond market. He wishes. I'm figuring he'll probably figure out some way to make, $1 billion off of
Exchange rates.
and maybe exchange rates, maybe. Let's do exchange rates. Same thing. Let's use this as the demand for dollars. Okay, demand for dollars. So you start in equilibrium and you shock the system. The demand for dollars increases. Lots of capital flight coming in from overseas because most of the world is in recession. Shifts up the demand curve. The demand for dollars increases and pushes up the value, not the price, the value of the dollar. I use P, but it should be the value of the dollar, not the price of the dollar, the value of the dollar. Okay? There could be a major sell-off in the dollar as people start to move out of dollars and into foreign exchange because maybe the return prospects are higher, or maybe the world starts to recover and bottom out from the recession. It looks like growth prospects are higher overseas than they are here. They will start to sell dollars.
Question for you.
Sorry, the demand. Go ahead.
What about the thing that Japan just did where they took their interest rate negative?
We'll talk about that over here.
Okay.
So the demand for dollars will drop. That will reduce the quantity demanded and reduce the price in the process. If the value of the dollar goes up, then the value of foreign currency goes down. If the dollar appreciates, then foreign currencies depreciate. Okay? If the dollar depreciates, foreign currency appreciates. Okay? So rise and fall of prices, appreciation, depreciation, appreciation, depreciation. Okay? Devaluation. What if over here the Treasury and the central bank decides to sell off dollars, shifting the supply curve out, putting more dollars on the market? The supply is going to increase and the value is going to drop. The value of the dollar is going to depreciate and foreign currency is going to appreciate. What if the central bank and the Treasury starts to buy up dollars to restrict the supply, to try to push up the dollar value, to cause it to appreciate, to allow us to import at cheaper prices in the marketplace as a currency strategy? What's going to happen is the supply is going to be restricted and the value of the currency is going to appreciate and foreign currency is going to depreciate in the process. What are some of the factors, again, that can be equated to demand for the dollar? So what are the factors that we came up with? GDP. Okay, GDP is great. Yeah, if we have higher growth prospects in the rest of the world, then they're going to sell their foreign currency and buy the dollar to invest here. Investor return.
Demand of gold.
Imports, exports. What did you say?
Demand of gold.
What?
The demand of gold.
Potentially. There could be some linkage or some kind of transmission mechanisms between the other asset classes. Definitely inflation. inflation differentials. If inflation is lower here and it's higher someplace else, why would you hold a foreign currency of higher inflation? Because it's, you know, eroding the purchasing power of your currency. You're going to sell that currency and you're going to buy the US dollar because it's not depreciating or eroding as quickly. There's also productivity, labor productivity. If labor productivity is higher here than it is someplace else, then that basically means that we are making more per unit of labor here than someplace else. Why would you be someplace else that's more inefficient? And why wouldn't you invest someplace here where your labor productivity rates are higher and your profit growths are probably higher too, because you're getting more revenue or earnings or cash flow per unit of labor than someplace else in the world. And so, do you have another comment?
No, I have a question. There's certain countries where their banks give you their your interest in dollars, though you deposit your money in their currency.
Okay, well, they better have dollars to be able to handle the dollar liabilities to pay those interest rates.
So what's your thought on that in general?
It's probably not a very big market. So it's not part of the multi-trillion-dollar foreign exchange market. It's probably a segment of it. So I wouldn't even think about it. They better have foreign currency to be able to pay the dollars, interest rates.
There are countries like Bahamas, and they would accept dollars on the street. So that way, that's their way of getting more dollars into the country.
Fear and political instability. Okay. How are we doing on time? I think that might be it for me. I'll do the financial integration, but I'll just tell you, I'm going to go over the yield curve theory, normal, flat, inverted yield curve, and the dynamics. How these yield curves and these risk-free rates basically feed into the cost of debt and equity. You take the capital structure of the firm, and you get the weights, and you know what the cost is. I will know that the weight of the equity and the cost of the equity using CAPM. I will know what the cost of the debt is, the interest rates associated with short-term, medium-term, long-term debt on the balance sheet. I will be able to calculate a weighted average cost of debt. I will know the rate of the debt. And since the interest on the bonds are tax deductible, there's also the tax shield. And I will be able to get the weighted average cost of capital. Weighted average cost of capital becomes the discount rate. We're going to buy a company, it's going to generate cash flows that are going to grow over time. We're going to be able to sell the company at some terminal value in the future. We're going to discount it back to get the present value. If the present value is greater than the price we buy it, it's equal, we buy it, it's less, we reject it. If the net present value is positive, we accept it, it's equal, we accept it. If it's negative, we reject it or ask for a price reduction. Internal rate of return greater than WACC, we accept it, equal to WACC, accept it, less than WACC, reject it, or ask for a price reduction. If the break even is less than 3 years, we do it. If it's equal to 3 years, we do it. If it's greater than 3 years, we reject it or ask for a price reduction. And then we may have to go back and review the discount rate, the growth rates, the terminal value, to see if we can re-underwrite this thing, to see if we can get it to work. And then the last piece is real options. We may do the financial analysis and reject the project, but still there's some intrinsic value of this real option. Just like the option over there, the option value is over here, but this is a real option, not a security. And this value may be huge to overcome the net negative present value, and we end up accepting the project because there's intrinsic values or IP or something that's not being measured in the financial analysis that will be embedded in the real option that will trigger us to be able to accept the project. So I'll go over that part next week. Okay? So.
In terms of tax